This video is actually about collateral, and it's kind of like, what is collateral? Collateral is any physical or intangible item that has value that you are giving to the bank to support your loan, that is pledged to your loan. And so anyway, the banker lender will actually sell these assets, your collateral, if you default on the loan and you throw them the keys or throw them, say, hey, I'm done. There are three ways the banks makes their money, and the number one is that your loan, you pay off this loan by making all the payments, and then and that's how they make money. Your loan, you make all the payments, and then you make all the payments till the loan is paid in full, and that's how they make money. That's their first way out. Banks actually have a second way out, and their second way out is that you give them collateral that is pledged to your loan, and then the lender, if you default on that loan, he will go ahead and take and sell that collateral. That's the second way out. Bankers don't like the second way out. They just want you to pay your loan until it's paid in full. And then there is a what I call the third way out. And the third way out is if money is still owed after the collateral is paid, the bank basically sues you in court to honor your personal guarantee. And yes, you will give a personal guarantee to any bank loan that you make. And that is not, I mean, you talk about that will make enemies real quick between you and the banker when he sues you, and he looks at your personal statement that you gave him and says, gee, what can you sell? What can I get? Because I got this personal guarantee that you pledged. You said you would honor it and that you would pay off this loan if I couldn't do it, through the first or second ways out. The best collateral is cash. I mean, obviously, it's 100% value for the bank. Cash or near cash. Near cash would obviously be stocks and bonds. Second best is real estate. Banks know real estate. Banks know how to value real estate. Banks can take a second lien if most people have a mortgage, and they will take a lien or a second lien on that real estate. Usually your home. Banks love homes. You got to live somewhere, and you don't want to sell your house. You want to continue living in it. So any loan that's tied to your house, you're going to try to pay that loan off. On the real estate, it really depends on the time that they're selling it. There's been time in the last 20 years that actually, it's been I remember in 2008 to 2010 when real estate was worth nothing. I mean, nobody was buying real estate. People were getting foreclosed on. Banks had tons of real estate and they couldn't move it. I mean, they had to reduce it and reduce it and reduce it. And they still couldn't sell it sometimes. So anyway, it does depend on the market situation for real estate, on really what it's worth and really can they get anything out of it. That is the second best collateral, would be the real estate. The third best collateral would be machinery, equipment, furniture, fixtures. And that, real estate, you'd probably get maybe, 80% of value. Usually sometimes liquidation is 70%. But when you're talking machinery or equipment, you're talking, they'll be lucky if they get 50% and probably less than that. So anyway, the banks will have to find a buyer for that. And if you're out of business and it's a recession, there might be other businesses that are out of business. And there might be a whole lot of this equipment, furniture, fixtures that is all out on the market. So sometimes, it really depends on the market there too. The fourth best, or we're getting to the bottom of the barrel here for what is collateral, would be inventory. But inventory really depends on what is your inventory. Is it finished goods that they can sell to people you've already sold to, or is this like parts, or is it ingredients that go to make up the whole thing? So it can be a very hard thing to sell inventory because you got to find another company that needs that inventory. Usually it sells in a very small part, usually, less than, maybe 25 cents on the dollar, something like that. But um, so anyway, there is another, and I consider it fourth or fifth, which is accounts receivable. And accounts receivable is actually amounts that other companies owe you because you sold them a product and they haven't paid for it yet. And that really depends on what company has that, gave you that receivable. Because there's a lot of companies, if it's a large company, an InBev or something that's huge, they're going to pay you. They're going to pay the bank. They're going to pay whoever. But if you got small companies, sometimes when they're the company that they purchased from and that they owe is out of business, they don't sometimes want to pay the bank. Sometimes they don't want to pay it at all. So anyway, sometimes it really depends on who has your receivable, whether it's really any good or not, to use as collateral. Um, Banks are known for trying to get, a larger amount of collateral, sometimes very large amounts of collateral, um, for the size of the loan. Sometimes they may get 2 or 3 times what they think, what the loan is in collateral. Um, to a bank, collateral is usually used a lot more, and will be a lot higher on a conventional loan. But to a bank, collateral, there is no limit. It's whatever you're willing to give. Um, if collateral falls short on the loan, then the bank a lot of times will go ahead and look at SBA to guarantee the loan. If they do that, it's an SBA 7A loan, which usually has a higher interest rate and usually has higher fees. So you really want to get a conventional loan if you can, but if you can't and the bank wants to do an SBA loan, it is a way of making the deal happen and getting your loan. Usually the SBA will be, they'll guarantee it 70 to 90%. And usually, or 75 to 90%. Usually it's 75. And that the 7A program is the workhorse of the SBA. The 7A program has been around since, I don't know, since SBA began. And they really are the workhorse. They do the most loans out of all SBA programs. And there are a couple lender rules on collateral. And the number one rule on lender collateral is that there never is enough collateral. You can always ask for more. There never is enough collateral. So if you're talking to a bank and you say, well, you should take this and that should be enough, well, he may say no, because to a bank, there is no limit on collateral. Anyway, and then the second part of that, the second rule to a lender on collateral is that they seldom or never will release your collateral. And this even no matter what they say, if they say, let's make this loan today, and 5 years from now, if you've paid it down, I'll release your collateral, I almost guarantee you they will not. Most banks keep the collateral until the loan is paid in full. So, you believe me or not believe me, but I'm telling you, most banks will not release collateral. And some of them will promise to release part of it later, but that's usually just to get the deal done. Lenders actually picking up loans or picking up collateral can be very messy. I worked at a small bank, and we had a embroidery company, and she was missing a lot of her payments. We tried to get her with a workout plan, which SBA wants you to do. That did not work. We went ahead and I drove the U-Haul truck. I met people from the bank at the business. We all moved in at one time. The lady who owned the business was actually recovering from cancer. She was crying. Her daughter was crying. Her daughter's friend was crying. And we were in the place ready to just carry out everything that was in the building. So anyway, she had a bankruptcy, but it was a personal bankruptcy, and these were business assets. So we had every right to take them. Somebody called the police, and it was a small town police force, and they came in and listened to everybody and said, we don't know who's right here. we're just gonna, you guys aren't gonna do this today. And once you have everybody assembled and you have everything ready to go, and you got the U-Haul truck, and you have to call it off, chances of you doing it the next day are very slim. What we ended up doing is we found a buyer for that, and I think it was somebody she knew. And when you're doing that, you got to be very careful because sometimes they have a straw buyer, which will basically, they'll have a friend that'll buy the equipment for 20 cents on the dollar and then give it back to them. Which I guess if you're the business, that's great. If you're the bank, that's terrible. So anyway, what we did was we ended up selling it to another person that did embroidery stuff, had a company, and he paid, I think, probably 30 cents on the dollar for this equipment. So anyway, that's it. That's the end of the video. Thank you very much. And, please subscribe, turn your notification on if you want to see future videos. And please, if you got any value out of this, I hope you did. If you got any value out of this, please hit the like button. And I'll see you in the next video.